There are a bunch of outlandish, unsubstantiated claims that proponents of IUL are promoting on TikTok and other social media platforms that are creating unrealistic expectations for those who own IULs. In today's video, I'll be debunking those claims one by one. Let me start by saying that, as you know, I like IUL. I promote it to my clients and prospects as part of a balanced, comprehensive approach to tax-free retirement. But we need to be clear on what IUL is and what IUL isn't. In today's video, I'm going to talk about 3 pie-in-the-sky, unsubstantiated claims that life insurance agents on social media are making about Index Universal Life. Claim number 1, the IUL will beat the stock market. The other day, I was watching a TikTok video where a life insurance agent made the extravagant claim that his particular IUL averaged 15.3% over a sustained period of time. That's 15.3% growth, tax-free, mind you. Who can beat that? In fact, why would you put your money anywhere else when you can get a 15.3% rate of return? Or so the thinking goes. Well, first of all, there is no IUL out there that has averaged 15.3% rate of return over a 20 to 30 year period of time. This defies the very laws of the investment universe. You can't even expect that in a stock market portfolio where you are taking substantial amounts of risk. Now, there are IULs that have experienced rates of return of 15% or higher in a given year, but that's not the same as averaging 15% over several decades. So where do TikTokers get these types of returns? Are they pulling them right out of the air? No, they're taking them from the back-tested models that these carriers provide to their agents. Essentially, what these companies do is they create a customized composite portfolio of indexes that is retro-engineered to show high rates of return. In other words, with the benefit of 20/20 hindsight, they show the rates of return you could have achieved had you been in this composite index over that time frame. Well, that's a little bit like me saying that had you been invested in Microsoft back in 1990, you'd be a billionaire today. In other words, back-tested performance is not the same as actual performance. In fact, it can be at times incredibly misleading. This approach is generally problematic because it creates unrealistic expectations around the rates of return you are likely to achieve in your IUL over time. The more prudent approach is to acknowledge that rates of return are in fact a function of several different variables. What are these variables? First, interest rates, short and long term. And second, the cost of options, which is primarily a function of market volatility. You can then look back at actual IULs that have weathered long periods of high interest rates, low interest rates, high market volatility, and low market volatility and see how they've performed. These are IULs that have experienced a wide range of index caps over a prolonged period of time. This will give you a much more realistic picture of the rates of return you are likely to experience in your IUL. And don't just look at one generation of IULs. Look at multiple generations of IULs. When you do that, you'll find that a good IUL with a dependable carrier will have averaged anywhere from 6 to 8% over that time frame. When you subtract out the average expenses over the life of that IUL, you arrive at a much more reasonable rate of return of between 5 and 7% net of fees over time. And while it's not as sexy as a 15% average rate of return, it's much more likely to play out in real life. Okay, claim number 2, you can't lose money in an IUL. This is something I hear all the time and it drives me absolutely bonkers. The claim goes a little bit like this. In the IUL, you can experience the upside of the market up to a cap and you're guaranteed to never lose money. That sounds good on the face of it, but it's not exactly true. The fact is that you are guaranteed to never be credited less than a 0 in your IUL, but during those flat years, you will continue to pay fees and the cost of insurance. And while this doesn't expose you to the same type of risk you might experience in, say, a variable universal life insurance policy where your returns are linked to the stock market, it does involve some risk. What's the risk? The risk is that your policy's cash value could take a hit through the combination of having paid fees and expenses and then taken a distribution or a loan in a year in which you also experienced no growth. So yes, you can, in fact, lose some money in an IUL. Now, this shouldn't be a big deal, particularly if you have other streams of tax-free income to buoy you up in retirement. Claim number 3, the IUL is a silver bullet. If you take IUL TikTokers at their word, you should only ever contribute retirement savings to Index Universal Life. It's the silver bullet. It's the panacea. It's one size fits all. No other investments measure up. Therefore, all your retirement savings should be earmarked towards this magical account. After all, if you can never lose money and you can average 15% per year, why would you ever consider anything else? Why mess around with the likes of Roth IRAs, Roth 401ks, or Roth conversions? Why bother taking money out of your IRA or 401k up to your standard deduction tax-free? The truth is that the IUL is not a silver bullet. It does precisely what it claims to do, which is gives you exposure to the upside of the stock market up to a cap with protection on the downside. It's not designed to give you stock market returns, and it doesn't give you a 100% guarantee against loss. It is, however, an amazing bond alternative. As I've said in other videos, reach into your portfolio, remove the bonds, replace them with Index Universal Life Insurance, and you'll increase your rate of return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. The IUL should be seen as a safe and productive way to generate reasonable rates of return as a complement to your other streams of tax-free income, not a replacement for. The ideal tax-free recommendation should have anywhere between 4 and 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket in retirement. In short, I like IUL, and I've defended it against the likes of Dave Ramsey, the White Coat Investor, Chris Kirkpatrick, and others. I've even written a book where I make the case that it's the best LIRP to help get you to the 0% tax bracket in retirement. But having said all that, we would all do well to manage our expectations as to the role IUL can play in our retirement picture. It is not a silver bullet. It is not a replacement for the stock market portion of our portfolio, and it will not generate 15% consistently over time. It could be more adequately described as a safe and productive way to grow a portion of your retirement portfolio while providing you a death benefit that you can spend in advance of your death for the purpose of paying for long-term care. If you need some help understanding how IUL fits into a balanced, comprehensive approach to tax-free retirement, head on over to DaveMcknight.com and click on the Work with David button. I'm happy to lend a hand. If you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.